The silence finally broke. On February 2nd, 2026, federal regulators walked into a small regional bank in the Midwest, shut the doors before lunch, and took control of every dollar inside. No crowds, no warning, no breaking news banner crawling across your screen. Just a quiet seizure that ended a financial institution that had been operating for more than 2 decades. And with it, the illusion that the banking crisis was behind us officially died. For months, we were told the storm had passed, that 2023 was the panic year, that 2024 was the cleanup year, that 2025 proved the system was resilient. Analysts went back on television, stocks marched higher, deposits stabilized, everyone breathed a sigh of relief. But that calm wasn't recovery. It was the quiet phase before structural failure. Think of the financial system like a bridge that's been overloaded for too long. At first, nothing happens. The metal bends quietly. The stress fractures form where no one can see them. Traffic keeps flowing. Reporters say everything is fine. And then one support beam snaps. That's what this first bank failure of 2026 represents. Not a random accident, a load-bearing failure. The bank itself wasn't massive, a few $100 million in assets, the kind of place local businesses used for payroll, the kind of branch your parents probably trusted for decades. But size is irrelevant when the pressure is systemic. This wasn't about one bad decision. This was about math finally winning. For the past 2 years, banks have been trapped in a financial vice. On one side, they're holding loans issued when interest rates were near zero. Mortgages, office buildings, commercial properties locked in at 3% returns. On the other side, they're forced to pay depositors 5% just to keep money from fleeing. Old assets earning pennies, new liabilities costing dollars. When more cash flows out than comes in, there is only one ending: collapse. That pressure has been building silently across hundreds of regional banks. And now, for the first time in 2026, it broke through the surface. Regulators moved in fast. They always do when they're trying to prevent panic. Management was removed, assets were transferred, depositors were told everything was safe. By Monday morning, the signage had changed and business continued like nothing happened. But behind the scenes, shareholders were wiped out. Unsecured lenders were erased. Another financial institution quietly buried. This is how modern banking crises unfold now, not with lines outside the door, with keystrokes. Money moves at the speed of fear. Deposits vanish in hours. Balance sheets implode before regulators finish their coffee. The visible drama is gone. The damage is faster and far more dangerous. And here's the part that should make you uncomfortable. This bank didn't fail because of fraud. It didn't fail because of reckless gambling. It failed because the economic environment finally caught up with it. It survived the 2008 crash. It survived the pandemic. It survived years of chaos. But it couldn't survive high interest rates. That tells you everything about where the real stress in the system is hiding. For years, easy money covered bad investments. Cheap debt allowed weak projects to survive. Rising asset prices made balance sheets look healthy even when the underlying math was broken. Now that the Federal Reserve slammed the brakes, reality is back, and reality is ruthless. Commercial real estate values are collapsing in major cities. Office buildings sit half empty. Shopping centers are worth far less than their loan balances. Borrowers can't refinance. They hand the keys back to the banks, and when enough borrowers walk away, the bank's capital evaporates. That is exactly what happened here. Not suddenly, slowly, quietly. Until one Friday afternoon when regulators decided the numbers no longer worked. For months, banks played a game known as extend and pretend. When borrowers couldn't pay, loans were quietly extended, losses were delayed, balance sheets were propped up by optimism and accounting flexibility. But you can only pretend for so long. Eventually, the math forces the truth. This first failure of 2026 signals that regulators are done pretending. They are forcing assets to be marked to reality. And when reality shows up, capital disappears fast. This is why this moment matters far beyond one bank. It confirms that the lag effect is now in motion. High interest rates don't break systems instantly. They act like slow poison. You feel fine at first. Spending continues. Markets rally. Confidence holds. Then, 18 to 24 months later, the damage surfaces all at once. We are now exactly in that window. The poison is working. What you're watching isn't a one-off failure. It is the beginning of a structural unwind that has been building for years. And history tells us, once the first domino falls, the rest do not stop politely. They accelerate. In the next phase of this story, I'm going to show you why regional banks across the country are sitting on the same ticking time bomb, how commercial real estate is becoming the toxic asset of 2026, and why the quiet banking era we just witnessed was never stability at all. It was the calm before systemic stress finally snapped. The uncomfortable truth is that this failure was predictable. Not because anyone had secret information, but because the balance sheets were already whispering what the headlines refused to say out loud. Regional banks across the country are carrying a concentration of risk that would make most investors uneasy if they actually looked at it closely. Nearly 70% of all commercial real estate loans in the United States sit on the books of small and mid-sized banks. Not the giants, not the mega institutions with trillion-dollar safety nets, the local lenders, the community banks, the institutions that depend on relationship lending and trust. For decades, that model worked beautifully. Local banks financed office parks, medical buildings, strip malls, warehouses. The loans were steady, the payments were reliable, the yields were modest but predictable. Then the world changed. Remote work hollowed out downtown towers. Retail foot traffic collapsed in certain corridors. Financing costs doubled, construction stalled, and suddenly, properties that were once considered conservative investments became speculative assets. Picture a landlord who borrowed $10 million at 3% to buy an office building in 2019. The math made sense then. Stable tenants, predictable rent, low rates. Fast forward to 2026. Half the building is empty. Tenants downsized. The loan matures. Refinancing now costs 8%. The property's value has dropped to $6 million. The bank calls and says the loan is due. The landlord can't pay. That difference does not disappear politely. It hits the bank's capital directly. Multiply that scenario by thousands of properties nationwide. That is the maturity wall. Over the next 2 years, more than $2 trillion in commercial real estate debt is scheduled to reset at dramatically higher interest rates. That number is not speculation, it is contractual. And small banks are holding a large share of it. This is why the first bank failure of 2026 matters so much. It confirms that regulators are no longer willing to let institutions quietly extend those loans indefinitely. The era of delay is ending. When a bank cannot absorb the loss, it is closed. Now consider the psychology this creates. Investors are not blind. They see the delinquency rates rising. They see office vacancy data hitting decade highs. They see refinancing spreads widening. Capital begins to retreat. When investors refuse to inject fresh money into struggling banks, those banks lose their buffer. They cannot raise equity. They cannot plug losses. They become fragile. We call this a capital strike. And once it begins, it spreads. Depositors sense the shift before the headlines confirm it. Large account holders quietly move funds to institutions perceived as safer. Money migrates from regional banks to the largest names in the country. This is deposit flight. It does not require panic, it requires doubt. In the digital age, doubt moves billions of dollars in minutes. There are no crowds outside the branch. There's no dramatic footage for the evening news. There are simply transfers executed through a phone screen while sitting at the dinner table. The first bank of 2026 did not collapse because of a dramatic run. It eroded, it lost margin, it lost capital, it lost time. And when time runs out in banking, closure is swift. This creates a feedback loop that is difficult to reverse. As deposits leave smaller institutions, their cost of funding rises further. They must offer higher rates to retain customers. Higher funding costs squeeze margins even more. The vice tightens, losses accelerate, confidence declines. The Federal Reserve is watching this unfold with limited tools. Cutting rates too quickly risks reigniting inflation. Keeping rates elevated prolongs the stress on banks holding low-yield assets. There is no painless solution. So policymakers attempt something more subtle. They encourage consolidation. Stronger banks absorb weaker ones. Assets are sold. Branches rebrand. The public sees continuity, but beneath that surface stability, power centralizes. Each failure removes another independent lender from the system. Fewer banks mean fewer sources of credit for small businesses. When credit tightens, expansion slows, hiring slows, investment slows. The economic consequences spread outward like ripples in water. Construction projects pause because financing evaporates. Developers cancel plans, contractors reduce staff, suppliers see orders decline. It begins in a balance sheet. It ends on Main Street. And here is where the risk becomes broader than commercial real estate alone. Regional banks are deeply intertwined with local housing markets. They finance builders. They underwrite development loans. They support small investors who own rental properties. If those institutions pull back sharply, housing supply shrinks further. Prices distort. Liquidity dries up. What starts as a commercial property problem can bleed into residential markets. That is why analysts are no longer treating these failures as isolated. They are looking for patterns. The first bank of 2026 may be small in asset size, but it is large in signal value. It signals that the lag effect is not theoretical, it is operational. And once the cycle of forced recognition begins, it is rarely limited to one institution. In the next phase, we need to examine something even more concerning. There is a specific financial indicator that historically begins flashing red right before a broader credit contraction accelerates. It is not discussed often because it sits deep in regulatory filings and bond spreads, but it is moving now. And if it continues in this direction, the pressure on regional banks will intensify far beyond what we have seen so far. This is where the story moves from warning shot to systemic stress. To understand why pressure is about to intensify, you have to look beyond bank headlines and into the bond market. This is where stress shows up first. Long before institutions fail publicly, lenders quietly demand higher compensation for risk. Credit spreads widen. Funding becomes more expensive. Liquidity thins. Right now, the yield difference between safe government bonds and debt issued by regional banks is climbing at a pace usually seen before recessions and financial crises. That gap represents fear. It is investors quietly voting that smaller institutions are becoming riskier by the week. When funding costs rise for banks already struggling with shrinking margins, the squeeze becomes relentless. Every basis point increase translates directly into lost profitability. And when profitability disappears, capital evaporates. This is the stage where problems stop being containable. Banks begin cutting back lending aggressively. Credit standards tighten. Loans that once sailed through underwriting now face rejection. Borrowers feel it immediately. Small businesses that rely on credit lines to manage cash flow suddenly find limits reduced. Developers who expected construction financing are told to wait. Home buyers face tougher qualification standards. The economy begins slowing not because of a headline crash, but because money quietly stops moving. This is what economists call a credit contraction, and it has already started. Recent surveys of bank lending officers show the sharpest tightening of standards since the global financial crisis. That shift rarely reverses quickly. Once banks turn defensive, they stay defensive. The first failure of 2026 accelerates this psychology. Every seizure reinforces fear. Every quiet closure makes risk officers more conservative. Every transfer of deposits to larger institutions drains liquidity from local lenders. This is how systemic stress spreads without a single dramatic event. At the same time, something equally important is happening beneath the surface. Regulators are increasing scrutiny. Examinations that once focused on growth and compliance now revolve around asset quality and capital sufficiency. Loan portfolios are being reviewed with a harsher lens. Losses that might have been deferred a year ago are being forced into the open now. This is why failures tend to cluster. Once the first bank falls, the regulatory environment tightens across the sector. That pressure reveals weaknesses that were previously hidden. It is not coincidence. It is contagion through oversight. Now, layer this on top of the refinancing wall still approaching. Even if commercial real estate values stabilize today, massive volumes of debt must reset at higher rates over the next 18 months. Many borrowers simply cannot afford the new payments. That means defaults are not a risk. They are scheduled. Banks know this. Investors know this. Regulators know this. What they do not know is which institutions will crack first. That uncertainty is what drives fear. And fear is the fuel of financial crises. This is where history becomes useful. Every major banking stress cycle follows a similar rhythm. First comes the period of denial. Markets rally, confidence returns. Analysts declare the crisis contained. Then a small failure occurs. It is dismissed as isolated. Then credit conditions tighten quietly. Then failures accelerate. By the time the public realizes what is happening, the system is already deep into contraction. We saw it in the savings and loan crisis. We saw it in 2008. And the early stages look remarkably similar now. The difference this time is speed. Digital banking allows money to flee instantly. Information spreads faster. Sentiment shifts quicker than ever before. What once took months can now unfold in weeks. That is why the first bank of 2026 carries so much weight. It marks the transition from calm to compression, from stability narrative to structural stress, from delay to recognition. Another factor quietly amplifying risk is insurance perception. While deposits are technically protected up to certain limits, many businesses hold far more than those thresholds in operational accounts. Payroll alone often exceeds insurance coverage. When corporate treasurers start questioning whether funds are fully safe at smaller institutions, they move quickly. And when businesses move deposits, they move large sums. That accelerates. Liquidity drains far faster than retail customers ever could. The result is a system where confidence becomes increasingly fragile. Banks rely on trust. Once trust weakens, balance sheets deteriorate at alarming speed. This is why authorities are acting preemptively now. Seizures happen quietly to avoid visible panic, but quiet action does not equal small risk. It signals urgency. The system is being stabilized in controlled bursts because uncontrolled collapse is the alternative. Yet every intervention has consequences. As consolidation increases, fewer institutions control more assets. Risk concentrates. The financial ecosystem becomes less diversified. That makes future shocks more dangerous. A failure in a centralized system carries far greater impact than in a distributed one. This is the paradox policymakers are now trapped in. Save stability today at the cost of fragility tomorrow, or allow chaos now to preserve resilience later. So far, they have chosen managed consolidation. But managed consolidation does not eliminate risk. It merely relocates it. And as credit continues tightening, the pressure will not remain confined to banking. It will move outward into employment, investment, housing, and consumer spending. Which brings us to the next critical piece of this unfolding story. There is one sector where falling liquidity and tightening credit tend to collide with devastating effect. It is the area where most household wealth is concentrated. And early signals suggest it is beginning to feel the strain already. If that pressure accelerates, the consequences will extend far beyond regional banks. The sector where tightening credit does the most damage is housing. Not stock portfolios, not corporate balance sheets. For most families, real estate represents the single largest store of wealth they will ever hold. It is also the area most dependent on constant access to financing. When credit flows freely, housing markets hum. Builders construct. Buyers qualify. Prices rise steadily. When credit tightens, everything slows. And when credit contracts sharply, housing does not correct gently. It freezes. We are already seeing the early stages of this shift. Mortgage approval rates are falling. Down payment requirements are increasing. Adjustable rate borrowers are facing payment shocks as refinancing becomes unaffordable. At the same time, regional banks that once specialized in construction loans and local development projects are pulling back aggressively. These institutions were the lifeblood of small builders and real estate investors. Without them, projects stall. Permits are delayed, developments sit unfinished. That slowdown ripples quickly through the broader economy. Construction employs millions of workers. It supports suppliers, logistics firms, manufacturers, and local service businesses. When housing activity cools, those jobs are among the first to feel pressure. And when employment weakens, consumer spending follows. This is how financial stress migrates from bank balance sheets into everyday life. Quietly at first, then suddenly. Another pressure point forming beneath the surface is household debt. Over the past several years, consumers leaned heavily on credit cards, personal loans, and auto financing to offset higher living costs. Balances rose rapidly while interest rates climbed. What once felt manageable now feels suffocating. Monthly payments consume larger portions of income. Savings rates have fallen, emergency buffers are thinner. When households are stretched and credit becomes harder to access, default risk rises. That feeds back into the financial system. Banks facing losses on consumer debt tighten lending even further. The loop tightens again. This is why economic slowdowns rarely stop at one sector. They cascade. The first bank failure of 2026 marks the point where financial stress began converting into real economic friction. Credit is no longer abundant. Liquidity is no longer assumed. Risk is no longer ignored. As this transition unfolds, businesses begin operating more defensively. Hiring slows, expansion plans are postponed, inventories shrink. When growth expectations fall, investment falls with them. Markets feel this shift before official recession indicators ever appear. Equity volatility increases, corporate bond yields rise, capital rotates toward perceived safety. We are watching those rotations now. Money is moving into short-term government debt. Demand for higher risk assets is weakening. Lending spreads continue widening. These are not panic moves. They are preparation moves. Smart capital does not wait for headlines to confirm danger. It responds to stress signals quietly. Another dynamic amplifying this moment is demographic pressure. A large portion of commercial real estate loans coming due are tied to properties owned by older investors nearing retirement. Many expected to refinance or sell at higher values. Instead, they face falling prices and rising borrowing costs. That forces difficult decisions. Some will walk away, some will sell at steep losses, some will default. Each outcome transmits losses back into the banking system. At the same time, younger buyers face affordability challenges that prevent them from stepping in to absorb supply. The result is declining liquidity across property markets. When assets cannot easily be sold, prices become unstable. This is when valuation gaps emerge. Sellers anchor to yesterday's prices. Buyers anchor to today's financing realities. Transactions slow, markets freeze. Frozen markets are dangerous for leveraged systems. Banks depend on asset turnover to maintain liquidity. When collateral becomes illiquid, risk multiplies. This is precisely what happened in past financial crises. Not because prices fell alone, but because markets stopped functioning smoothly. The current environment shows early signs of this friction. Commercial property transaction volumes are down sharply. Residential sales remain depressed in many regions. Financing delays are increasing. Liquidity is thinning. Thin liquidity magnifies volatility. Small shocks produce large moves. This is why policymakers are increasingly concerned about maintaining confidence, not because confidence is abstract, because it is structural. When confidence holds, people transact. When confidence breaks, activity stalls. And stalled activity is what turns financial stress into recession. The quiet bank seizure that opened 2026 did more than remove one institution from the system. It reminded markets that risk has not disappeared. It signaled that regulators are forcing losses into the open. It confirmed that the lag effect has arrived. What happens next depends largely on how quickly these pressures accumulate. In some cycles, stress builds slowly before erupting. In others, acceleration arrives suddenly once critical thresholds are crossed. There is growing evidence we are approaching those thresholds. Loan delinquencies are rising, liquidity is tightening, credit standards are hardening, asset values remain under pressure. Individually, each trend is manageable. Together, they form a system under strain, and systems under strain rarely stabilize quietly. They either gradually deleverage over many painful years, or they experience rapid adjustments that force change quickly. The first failure of 2026 suggests the second path may be unfolding, but the most revealing signal has not yet fully emerged. There is one final mechanism that tends to activate when financial stress transitions into full economic slowdown. When it begins flashing consistently, the shift becomes difficult to reverse, and signs indicate it is starting to stir now. The final mechanism that turns financial stress into full economic slowdown is confidence in future income. When households believe tomorrow will be stable, they spend, invest, and plan. When uncertainty rises, behavior shifts fast. Right now, that shift is underway. Consumers are pulling back on discretionary purchases. Businesses are freezing hiring. Investment committees are delaying expansion projects. Not because a recession has officially arrived, but because the signals are becoming harder to ignore. Credit is tighter, liquidity is thinner, risk is rising. And when enough people act defensively at the same time, the slowdown becomes self-reinforcing. This is how financial cycles turn, not in a single dramatic crash, but in millions of quiet decisions to spend less, borrow less, and wait. The first bank failure of 2026 was not the cause of this shift. It was the confirmation of it. It marked the moment when the lag effects of high interest rates moved from theory into reality. For nearly 2 years, the economy absorbed tighter monetary conditions with surprising resilience. Jobs remained strong, markets recovered, growth continued. But beneath that surface strength, pressure accumulated. Commercial real estate values slipped, loan margins compressed, household debt loads expanded, liquidity slowly drained from smaller institutions. The system did not break immediately because systems rarely do. They bend, they stretch. They hide stress in corners no one is watching, until the weakest point finally gives way. That first closure was the weakest point. And once the weakest point fails, the rest of the structure becomes far more vulnerable. History shows that banking cycles almost never end with a single isolated failure. They unfold in waves. What makes this cycle particularly delicate is the concentration of risk created by years of easy money. Cheap financing encouraged leverage across property markets. Low rates masked fragile business models. Rising asset prices created a sense of permanent stability. Now, those conditions have reversed. Debt is expensive. Values are adjusting. Liquidity is scarce. The financial system is being forced to reprice risk rapidly after a decade of distortion. The process is never painless, but it is necessary. Bad debt must be recognized. Over-leveraged assets must reset. Weak institutions must either consolidate or exit. This is what economists call creative destruction. In textbooks, it appears clean and efficient. In reality, it is messy, disruptive, and deeply personal for the communities affected. Local banks disappear. Small businesses lose longtime lenders. Projects stall. Jobs are cut. Wealth shifts toward larger institutions with greater access to capital. Power centralizes. The system becomes simultaneously stronger in the short term and more fragile in the long term. Stronger because weak links are removed. Fragile because risk concentrates. This is the trade-off unfolding now. The first bank of 2026 did not fail because the economy collapsed. It failed because the economy is adjusting to a new financial reality. Higher rates mean lower asset values. Lower liquidity means tighter credit. Tighter credit means slower growth. Slower growth exposes weak balance sheets. And exposed balance sheets lead to closures. It is a chain reaction rooted in math, not emotion. But emotion accelerates it. Fear speeds up deposit flight. Caution slows investment. Uncertainty freezes transactions. Together, those behaviors amplify economic stress. This is why policymakers walk such a narrow line. Cut rates too quickly and inflation reignites. Hold rates too high and financial stress deepens. Intervene too aggressively and moral hazard grows. Do nothing and contraction accelerates. There's no perfect solution, only trade-offs. What is increasingly clear is that the era of effortless growth fueled by cheap money is over. The economy is transitioning into a period where capital is more expensive, risk is priced more carefully, and weak structures are no longer supported indefinitely. That transition will feel uncomfortable. At times it will feel frightening, but it is also how financial systems reset after long distortions. The quiet seizure that opened 2026 will not be remembered for its size. It will be remembered for what it signaled. It told markets that the lag effect has arrived. It confirmed that losses are being forced into the open. It marked the shift from delay to adjustment, from stability narrative to structural recalibration. The system is not collapsing overnight. It is rebalancing under pressure. Some institutions will not survive that process. Others will emerge stronger. The economy will slow before it stabilizes. And confidence will fluctuate as reality replaces the optimism of the easy money era. The first bank of 2026 just fell, not as a singular disaster, but as the opening chapter of a broader financial transition already underway. The system is not breaking in chaos. It is breaking in order to reset. And how smoothly that reset unfolds will shape the economic landscape for years to come.